SCHD versus SCHG. This single investment decision will determine whether you retire with $1.25 million or $8.58 million. The same investment with the same time frame, but a staggering $7.3 million difference that separates a comfortable retirement from generational wealth. This isn't some Wall Street horror story. It's the brutal reality of choosing the wrong ETF. In the next few minutes, I will show you exactly why the battle between SCHD and SCHG isn't just about dividends versus growth. It's about the difference between a comfortable retirement and generational wealth. And here's the shocking part. 90% of investors are making this decision based on completely wrong information. In this video, I'll show you and Eric exactly how a $100,000 investment in these two ETFs creates dramatically different outcomes, why the conventional wisdom about choosing between them is dead wrong, and the precise strategy that could help you capture both income and explosive growth. By the end, you'll understand exactly which approach matches your financial goals and why you might not have to choose between them at all. Here's what drives me crazy about most investment advice. Everyone treats SCHD versus SCHG like it's a coin flip. Income or growth, safety or risk, conservative or aggressive. But what if I told you this entire debate is built on a completely wrong foundation? Most financial advisors will look at your age, glance at a risk tolerance questionnaire, and make their recommendation in under 5 minutes. Young investor, obviously SCHG. Getting close to retirement, SCHD is your answer. But here's what they're not telling you, and it's costing their clients millions. The real battle isn't between these two ETFs. It's between outdated thinking and the strategies that sophisticated investors are quietly using to dominate both approaches. Let me break this down in a way that will change how you think about ETF investing forever. When most people hear about SCHD, the Schwab U.S. Dividend Equity ETF, they think boring dividend fund. But that reaction tells me they've never looked under the hood of this wealth-building machine. Currently trading around $27.79 with over $68 billion in assets, SCHD isn't just collecting dividend, it's engineering a specific type of financial freedom that most investors completely misunderstand. Here's where it gets interesting, and why I think most people are analyzing SCHD all wrong. This fund doesn't just focus on high dividend yields like most income funds. Instead, it targets something far more valuable: dividend aristocrats. These are companies that haven't just paid dividends. They've increased their dividend payments every single year for at least 10 consecutive years. Think about what that actually means. We're talking about companies like Coca-Cola, which has raised its dividend for 62 straight years, surviving the dot-com crash, the 2008 financial crisis, and the 2020 pandemic. Or Chevron, which has been rewarding shareholders consistently through every oil boom and bust cycle. These companies have proven they can generate cash in any economic environment. But here's the part that will shock you. SCHD's current dividend yield sits at 3.64%, and most people hear that number and think, okay, steady income. They're missing the real story completely. With an expense ratio of just 0.06% and a dividend growth rate averaging around 11% annually, your income stream from SCHD doesn't stay at 3.64% forever. It doubles approximately every 6.5 years. Let me paint this picture with real numbers that might change how you think about this fund forever. Your initial $100,000 doesn't just earn $3,640 in year one. By year 10, your investment has grown to $231,400, now generating $9,700 annually. That's enough to cover your entire annual car payment. By year 20, your portfolio reaches $537,000, kicking out $23,660 yearly. Now, you're covering your property taxes and utilities combined. And by year 30, your investment has ballooned to $1.25 million, generating $65,000 in annual dividends. That's more than many Americans earn from their full-time jobs, and you never sold a single share. But before you think SCHD is the obvious winner, let me show you what happens when you put that same $100,000 into its growth-focused cousin. SCHG, the Schwab U.S. Large Cap Growth ETF, represents something fundamentally different, and it's why smart money is paying attention. Trading at $28.95 with $37 billion in assets, SCHG doesn't just hold growth stocks. It holds the innovation engines of the American economy, and the difference is more important than most investors realize. When you buy SCHG, you're not just buying stocks. You're buying pieces of the companies that are literally building tomorrow's world. Apple, revolutionizing how we interact with technology. Microsoft dominates cloud computing and artificial intelligence. Nvidia, powering the AI revolution that's transforming every industry. Amazon, redefining commerce, logistics, and cloud infrastructure. Here's what fascinates me about these companies and why SCHG's approach is so powerful. These aren't just businesses, they're innovation multipliers. Every dollar they earn gets reinvested into research and development that creates multiple dollars of future value. When Nvidia develops the next generation of AI chips, when Microsoft creates revolutionary cloud solutions, when Apple invents the next must-have device, you profit from all of it. The numbers behind SCHG tell a story that might make you rethink everything you thought you knew about wealth building. With an average annual return of 15.93% and an ultra-low expense ratio of 0.04%, SCHG turns modest investments into life-changing wealth. Here's that same $100,000 journey through a completely different lens. By year 10, your investment has exploded to $441,000. That's enough to buy a luxury car outright or put a massive down payment on your dream home. By year 20, we're looking at $1.94 million. This is quit your job and pursue your passion money. And by year 30, your portfolio reaches an astronomical $8.58 million. This isn't just retirement money. This is generational wealth that changes not just your life, but your children's and grandchildren's lives too. Now, I know what you're thinking. These numbers seem almost too good to be true. But here's where the real battle begins, and why your choice between these two approaches could be the most important financial decision you ever make. Let me show you exactly where SCHD and SCHG go head-to-head, because understanding this comparison will reveal something that most investors never see coming. At the 10-year mark, SCHD delivers $231,400 with $9,700 in annual income, while SCHG reaches $441,000 with $1,700 in annual income. SCHG is winning the wealth race by $209,600, but SCHD is building a solid income foundation. The 20-year mark is where things get interesting. And this is the inflection point that changes everything. SCHD grows to $537,000 with $23,660 in annual income, while SCHG balloons to $1,944,000 with $7,600 in annual income. Suddenly, SCHG's lead becomes substantial. We're talking about an extra $1.4 million. This is where the power of compounding growth really starts showing its muscle. But the 30-year comparison is where this battle reaches its knockout moment. SCHD reaches $1.25 million, generating $65,000 annually, while SCHG hits $8.58 million with $34,500 in annual income. The gap isn't just significant, it's $7.3 million. This is where a single investment choice made decades earlier determines whether you're comfortable in retirement or wealthy enough to change your family's financial future forever. Yet, here's what bothers me about how most people analyze these numbers, and it's the reason why so many investors make the wrong choice. Conventional wisdom tells you to pick one based on your age or risk tolerance. Young? Go SCHG. Near retirement? Choose SCHD. But what if there's a smarter approach that most financial advisors never mention because it requires more sophisticated thinking? Instead of viewing this as an either-or decision, sophisticated investors are using what I call the dynamic allocation strategy. Rather than putting all $100,000 into one ETF, you strategically split your investment based on life phases. And this isn't just diversification, it's optimization for maximum wealth building. Here's how the framework actually works in practice. During phase 1, from ages 20 to 40, You allocate 70% to SCHG and 30% to SCHD. This maximizes your growth potential while building an income foundation. Your money grows aggressively through the innovation companies while establishing dividend streams that will become more important later. Phase 2, from ages 40 to 55, shifts to 50% SCHG and 50% SCHD. This balances explosive growth with increasing income needs while reducing volatility as you approach your peak earning years. You're still capturing significant growth, but building more stability into your portfolio. Phase 3, ages 55 and beyond, moves to 30% SCHG and 70% SCHD. Now you're prioritizing income while maintaining growth exposure, providing stability with continued wealth-building potential. But here's the advanced move that could save you tens of thousands in taxes over your lifetime. And it's something most investors never consider. Account placement strategy is where sophisticated investors separate themselves from the crowd. Keep SCHD in your tax-advantaged accounts like IRAS and 401ks. Why? Those dividend payments are protected from immediate taxation, allowing more money to compound over time. Hold SCHG in your taxable accounts, where the growth is only taxed as capital gains when you sell, and at lower rates than ordinary income. This simple strategy optimization could be worth more than the difference between the ETFs themselves. Yet, most investors never think about it until it's too late. So, how do you decide? Here's the framework that cuts through all the noise. Choose SCHD. If you need income, within the next 10 years, market volatility keeps you awake at night. You're prioritizing steady, predictable returns, or you're already in or approaching retirement. Choose SCHG. If you have 15 or more years until you need the money, you can handle market ups and downs, you're prioritizing maximum wealth accumulation, or you have other income sources covering your current needs. Choose the combined strategy. If you want the best of both approaches, you can actively manage allocation changes over time. You understand tax-advantaged account placement, and you're building a comprehensive wealth plan rather than just picking investments. If you enjoyed this video, I want to show you how to pair SCHD with 4 other ETFs to crush market returns. Click the video on your screen right now.